Everyone kept waiting for retail investors to flood back into crypto and pump altcoins to the moon. We were told that once Bitcoin broke all-time highs, the retail horde would kick down the doors and send everything else flying. But well, that didn't happen, did it? Even when Bitcoin hit new all-time highs in October 2025, retail interest didn't show up in size. And here's the uncomfortable truth that nobody wants to admit. Retail investors didn't disappear. They didn't stop gambling. They just found new casinos. And right now, those casinos are eating crypto's lunch. From the explosion of prediction markets to the sports betting mania to the trading of options on tech stocks on Robinhood, the speculative capital that used to fuel altcoin seasons is flowing elsewhere. Retail has checked out of the tech thesis and checked into the casino. But is this permanent? And what does it mean for
your portfolio if the retail wave never comes back? That is exactly what we are diving into today. My name is Nick, and you're watching the Coin Bureau. First things first, let's look at the evidence, because the numbers are quite frankly shocking. The narrative some continue to peddle on X is that we are just one green candle away from the 2021 style mania. But if you look at the actual data, retail participation is sitting near a multi-year low. Take Coinbase, for example. Their monthly transacting users, the key metric for retail engagement, are down significantly from their 2021 peak of 11.4 million. By late 2025, that number had dropped to around 7.8 million. And it's not just users leaving, it's the volume. Exchange volume data shows that retail participation has effectively vanished. In the second quarter of 2025 alone, trading volume on top exchanges dropped by over 27%, wiping out $1.5 trillion in visitor activity. And the smoking gun comes from Robinhood's latest earnings report. Robinhood released their Q4 2025 earnings in February 2026, and it was a bloodbath for crypto. While their options and equities revenue climbed, cryptocurrency revenue plummeted 38% year-over-year to just $221 million. Think about that. Bitcoin was trading near all-time highs, yet the average Robinhood user, the ultimate retail proxy, was trading less crypto, not more. And if you think that's bad, just look at Google Trends. Interest in the term "buy Bitcoin" is sitting at a score of 11. Now, for context, it was at 100 in 2017 and 45 in 2021. The general public simply does not care. They aren't searching for how to buy crypto or best altcoins. They've moved on. So, where did they go? Did they suddenly become responsible savers, putting their money into index funds? Of course not. They didn't stop speculating. They just swapped their exchanges for prediction markets. Point number 2 is the rise of the event contract. Platforms like Polymarket and Kalshi have absolutely exploded in popularity. We're talking about a 130-fold increase in monthly trading volume from early 2024 to the end of 2025. Total notional trading volume across these platforms hit over $44 billion in 2025. Kalshi alone saw its user base grow from 600,000 to 5.1 million in under 12 months. That's an 8.5 times increase. And it makes perfect sense. For Gen Z and millennials, betting on elections, Fed interest rate decisions, or geopolitical events feels a lot more tangible than betting on a Layer 2 roll-up or a governance token. It offers the same adrenaline rush, the the same volatile odds, and the same potential for quick windfalls. But the outcome is based on real-world events they actually understand. Why wait 4 years for a crypto cycle to play out, when you can just bet on the outcome of a court case or a football game and get paid out tonight? And speaking of football, that brings us to the biggest competitor crypto has ever faced: legalized sports betting. Since the U.S. Supreme Court opened the floodgates, billions of dollars have poured into apps like DraftKings and FanDuel. In 2025 alone, Americans legally wagered nearly $150 billion on sports. DraftKings reported over $6 billion in revenue for fiscal year 2025, up 27% year over year. And the scary part for crypto, the dopamine loop, is identical. You open an app, you see volatile odds, you place a bet, and you get instant results. But there is one key difference. Sports betting has mainstream acceptance and zero learning curves. You don't need to understand private keys, gas fees, or bridging to Arbitrum to bet on the Super Bowl. You just download the app and hit place bet. And retail loves the high-risk, high-reward stuff. Parlay betting, where you chain multiple bets together for massive potential payouts, now makes up over 35% of total sportsbook volume. And that is the exact same psychological itch that altcoin speculation used to scratch. The moonshot mentality hasn't left. It's just migrated to a different app. Now, before we get into the one area of crypto that is still seeing retail action, I want to mention something important about keeping up with these shifts. The market is changing faster than ever, and if you are still using a 2021 playbook in 2026, you are going to get left behind. And that is why we've got the Sovereign Alpha channel. It's over here where we share the latest breaking news, provide deep dive alpha and actionable market updates every single day, pinged directly to your mobile device so you don't miss a thing. Subscribe now and turn on notifications. Okay, back to the crypto casino, because there is one sector that retail hasn't abandoned. In fact, they are doubling down. Meme coins. The only crypto sector still attracting some retail volume is the one that makes zero pretense about being, quote, technology. Platforms like Pump Fun have generated hundreds of millions in revenue by allowing anyone to launch a token in seconds. At its peak in early 2025, Pump Fun was pulling in over $250 million in quarterly revenue. It became a factory for churning out new tokens. But here's the kicker. Less than 1% of those tokens ever graduate or maintain any value. It is pure gambling. Retail has spoken clearly. They were never here for decentralized finance or the future of supply chain logistics. They were here to gamble. And now the mask is off. They prefer the honesty of a meme coin to the false promises of a, quote, utility token. But even this sector is burning people out. We saw the Trump meme coin scandal where retail investors lost nearly $2 billion, while insiders cashed out $320 million in fees. We saw the celebrity token Meta collapse, with coins down 98 or 99%. This nihilism is creating a trust deficit that is hard to recover from. And that leads us to the next massive problem: VC fatigue. Retail investors are exhausted. They're tired of being used as exit liquidity for venture capital firms. A report from Momento Research tracked 118 major token launches in 2025 and found that nearly 85% of them are underwater. If you bought a VC-backed token at launch in 2025, the median loss was over 70%. We all know the game by now. Projects launch with a low float and a high, fully diluted valuation. The VC gets in at pennies. The token launches at billions. And then the unlocks start hitting the market, drowning retail buyers in supply. Why would retail investors buy a, quote, tech token, knowing that there are billions of dollars of locked tokens waiting to be dumped on their head? They wouldn't, and they aren't. They would rather bet on a football game where they know the odds are at least transparent, or just buy a meme coin where everyone knows it's just a pure gamble. So what does this mean for the market structure right now? Well, it explains why Bitcoin dominance is hovering near 60%, which is multi-year highs. The institutional and retail money flowing into the market through ETFs is sticking to Bitcoin and Ethereum. BlackRock's clients aren't buying your favorite small-cap governance token. We've seen over $56 billion in cumulative inflows into Bitcoin ETFs, but that money is structurally walled off. It doesn't rotate. In previous cycles, profits from Bitcoin would flow into Ethereum and then into the high caps and then into the low caps. But that trickle-down effect is broken because ETF investors are not crypto natives. They are passive allocators, and this leaves altcoins in a dangerous spot. Without a fresh wave of retail speculation to buy the bags, technology-focused altcoins are bleeding against Bitcoin. The altcoin season index is sitting at 25 out of 100. We are in deep Bitcoin season, and without retail, there is no catalyst to flip the switch. So, is it all over? Is retail gone forever? Well, not necessarily, but the return path is very narrow. Retail usually comes back for two reasons, and one is the wealth effect from making money elsewhere like stocks or housing that then rotates into crypto risk, or two, a full-blown mania that dominates headlines and creates lots of FOMO. Right now, neither is happening. The Federal Reserve is the wild card, though. If they cut rates aggressively in 2026 and liquidity floods the system, we might see a resurgence. But hoping for the Fed to save your altcoin bags is not a strategy. What's the verdict? To be blunt, the crypto market has matured, but in doing so, it has lost its primary engine of volatility, the retail gambler. Those people have moved on to faster, simpler games like Kelshi, DraftKings, and meme coins. The days of everything pumping together are unfortunately behind us. The market is bifurcating. You have Bitcoin and Ethereum as institutional assets. You have meme coins as the retail casino. And you have the massive middle class of utility tokens that are struggling to find a buyer. If your portfolio depends on a wave of retail investors coming back to buy your Ethereum killer or your decentralized Airbnb token, you might be waiting a long time. I've been waiting a long time. Unfortunately, the retail crowd isn't reading white papers anymore. They're checking the spreads on the Chiefs game. But what do you think? Are you seeing your friends leave crypto for sports betting? Or do you think the retail wave is just around the corner? Let me know in the comments down below. And if you want to know more about what specific altcoin sectors might actually survive this purge, you can check out our video on that right over here. And if you want to understand the full impact of Bitcoin ETFs on this cycle, then check out that video right over here. Okay, that's all from me today. Thank you guys very much for watching, and I'll see you again soon.